The economy is quietly shifting and most people have no idea. By the time 2025 ends, there's going to be 5 economic shifts in full swing. They are: number 1, changes in the Federal Reserve Bank on who's going to be making the decisions. Number 2, changes with interest rates and how that's going to impact the economy in 2026. Change number 3, changes with global currencies as countries around the world try to move away from the dollar. Change number 4 are tariffs, taxes, and inflation, pretty self-explanatory. And change number 5 is the debt stress that we're seeing in the United States. Now, here's the thing. The rich and the financially savvy understand this. That way they can find investment opportunities to capitalize on this. Everybody else just kind of lets it happen, and then they get blindsided when things change. And I want you to be somebody that can find the opportunity instead of just watching the changes happen. And that's what I'm going to be breaking down in this video, starting with shift number 1, the Federal Reserve Bank. Now, just so we're on the same page, here's how the Federal Reserve Bank works. The United States government goes out and generates tax dollars. I'm not going to explain how they generate tax dollars in this video, but there are many ways that the United States government generates taxes, from things like your income tax, your capital gains taxes, corporate taxes, sales taxes, and everything in between. So the United States government generates these tax dollars, and then they go out and spend this money. What do they spend this money on? It could be infrastructure, it could be healthcare, it could be social security, it could be welfare, it could be a whole lot of things. The problem is the government is spending more than what they're generating in taxes. And when they spend more money, they need to go out and raise that money from debt because the government can't print this money out of thin air. So now the question is, who does the United States government actually borrow this money from? Well, they can borrow this money from people like you and me, regular people. They can borrow this money from foreign countries, or they can borrow this money from the Federal Reserve Bank. Now, why would anybody lend money to the United States government? Because when you lend money to the United States government, they're going to pay you back plus interest. The problem is there's not enough people and money in foreign countries to lend money to the United States government. That's why they also turn to the Federal Reserve Bank. Now, although they're called the Federal Reserve Bank, they're actually not a bank because you and I can't go there to deposit money. They're not a reserve because they're not sitting on any cash, and they're not federal because they're technically not a part of the United States government. It even says so on their website. But the Federal Reserve Bank is the central bank in the United States, which gives them the power to control interest rates, which I'll talk about in number 2, but it also gives them the power to print money. So the Federal Reserve Bank can now print this money out of thin air, lend it to the United States government, and then the government can go out and spend that money. This is where things get interesting because we're seeing a shakeup happen at the Federal Reserve Bank in 2025, and you bet that shakeup is going to continue in 2026. President Trump from the government has been demanding lower interest rates from the Federal Reserve Bank ever since he entered the White House. But up until now, the Federal Reserve Bank has said, no, we are not going to cut interest rates because we're concerned about inflation. And this is where President Trump has made it very clear that he wants to replace members in the Federal Reserve Bank. That way he can replace them with people who want to cut interest rates. But the government doesn't control the Federal Reserve Bank per se. That's why it's been very difficult for President Trump to try to remove people out of the Federal Reserve Bank. This is where some economists are warning that President Trump attacking the Fed could erode trust in the system. And then we have the head of the ECB, the European Central Bank, calling the changes to the Federal Reserve Bank, quote, a very serious danger to our economic system. Why? Because the Federal Reserve Bank controls the money in the United States economy. And of course, the United States dollar is the world's reserve currency. So it's not just impacting the United States, it impacts the global economy. And President Trump has been working to remove people out of the Federal Reserve Bank, although the firing of a Federal Reserve Bank official is now going through a lawsuit. We don't know exactly what's going to happen with that in 2025, but what we do know is in 2026, the chairman of the Federal Reserve Bank, whose name is Jerome Powell, is going to see his term end. And when his term ends, it is pretty much expected that President Trump is going to remove Jerome Powell with somebody who is going to want to cut interest rates aggressively, which means you have to expect a shakeup at the Federal Reserve Bank coming in 2026, which brings us to shift number 2, changes with policy. Because if we see a shakeup at the Federal Reserve Bank, well, now these people working at the Fed are going to probably want lower interest rates, because previously the Federal Reserve Bank has said, no, we're not going to cut interest rates because we're concerned about inflation, we're concerned about tariffs. Well, if these new members come into the Federal Reserve Bank in 2026, Well, they're probably going to want lower interest rates because the government is going to appoint people that President Trump wants. Now, for full transparency, the Federal Reserve Bank's next meeting is on September 17th, 2025, and they're expected to announce if they want to cut interest rates or not. And a lot of people are thinking that now maybe the Fed is going to listen to what President Trump is saying, and maybe they'll start cutting interest rates. We don't actually know for sure, but this is something you want to keep in your calendars. The reason why is because these interest rates impact every aspect of our economy. And up until now, the Federal Reserve Bank has been against cutting interest rates because they're concerned about inflation, they're concerned about tariffs, they're concerned about the economy. So they hadn't been cutting interest rates yet. But we do know that the tone at the Federal Reserve Bank has been changing. Like in July, when the Federal Reserve Bank met, there were multiple members at the Federal Reserve Bank who disagreed with their choice to not cut interest rates, saying that, hey, we should be cutting interest rates, we should be listening to what President Trump is saying. But let me diagram why these interest rates are so important for you to pay attention to, because our economy, our entire economic system runs on spending. And the largest spender in the United States economy is not you, me, Amazon, or Tesla, it is the United States government. So when the United States government goes out and they spend more money, well, that ultimately boosts the economy. Well, the United States government also has a problem that I'm going to discuss in number 5, which is they have around $37 trillion worth of debt. Well, where is that debt owed? Well, we could just follow the trail. Part of it is owed to the Federal Reserve Bank, part of it is owed to individual people, part of it is owed to foreign countries. Well, the fastest growing expense for the United States government is not welfare, it's not healthcare, it's not infrastructure, it's not research and development, it's interest expenses. Why? Because number one, the United States government has so much national debt, and number two, because interest rates on that debt have gone up so much since 2020. Well, if we see lower interest rates, not only does that mean that people could go out and borrow money for a mortgage or a car cheaper, but what it also means is that the United States government could refinance that debt at a lower interest rate, which means, hey, if the government is paying higher interest rates on this $37 trillion and now they can pay it at a lower interest rates, well, now the United States government can save money. But that's assuming that they don't go out and borrow more money, because what ends up happening a lot of times you see lower interest rates is that people want to take advantage of lower interest rates by going out and borrowing more money. So if hypothetically, we don't know for sure, but if the government goes out and they borrow more money, well, that could mean that they could spend more money. If they spend more money, that could boost the economy. However, it comes at a risk and a potential consequence, which of course could be inflation, which is something that you want to pay attention to. But this growth in spending could boost certain aspects of the economy, which could create unique investment opportunities, which is why, again, if you're an investor or want to become an investor, you want to pay attention to this. And I also put together a free investing masterclass where I'll walk you through how you can start investing and find hidden investment opportunities before everybody else. I'll show you the exact system that my firm and I use to research investment opportunities. So if you want to watch this investing masterclass for free, I have the link for you to watch it down in the description below. And when you sign up for the investing masterclass, you're also going to get market briefs, my newsletter for investors, complimentary as a bonus. This brings us to the third shift, which is changes to global currencies. The United States dollar has been the world's reserve currency since the 1940s. That means countries use the United States dollar for trade, they use it for transactions, and they use it for security because the United States dollar has been looked at as this holy grail of money. But now more than ever, we're seeing that dollar dominance be tested. We have foreign countries like China and India and Russia that are building their alliances to fight against the dollar. Now, there's a couple of reasons for this happening. Reason number one is some people are concerned about the value of the dollar, considering how much national debt that we have. So they're concerned that the value of the dollar is dropping because it's no longer backed by physical gold. Decades ago, the United States dollar was backed by precious metals like physical gold. So if we wanted to borrow more money, we needed more wealth, which was measured in physical gold. Today, that's not the case. And so some countries are concerned that if the United States government can just borrow unlimited amounts of money, the value of the dollar can be inflated into oblivion. Reason number two is some countries don't want to be subservient for the United States dollar. They don't like being bullied with tariffs. They just don't like working with the United States, or they want to surpass the United States themselves. In any case, these two things are leading to a concept called de-dollarization, which is where countries are working to try to distance themselves from the United States dollar and trying to strengthen their own potential currencies. For example, the BRICS nations, Brazil, Russia, India, China, China and South Africa have come together and built an alliance to try to build their own currency to try to combat the United States dollar. And there's been rumors and people talking about how this new currency is going to be backed by a physical metal like physical gold to help bring strength to that currency. And this is one of the reasons why gold has been breaking record highs, because some investors are saying, you know what, to hedge myself and protect myself against the United States dollar losing value, how about I own a hard money, something like physical gold. Now, just because gold goes up doesn't mean that it could ever go down. We saw gold prices boom after the 2008 recession because a lot of people were worried about similar things back during 2008, because back then we printed so much money during quantitative easing that people were concerned about hyperinflation, so they bought up gold. And gold prices boomed until 2012. But then in 2012, it became clear that hyperinflation was not happening and the United States dollar was going to continue to stay dominant. And that was when gold prices crashed after 2012, and they stayed low until 2020. So gold prices did not hit new record highs from 2012 until 2020, when people started to be concerned about the United States dollar again. So when people are concerned about the dollar, gold does good. When people are not worried about the dollar, gold doesn't do as good. And this now brings us to the fourth shift, which is tariffs, taxes, and inflation, which has been a very hot topic in 2025. And it doesn't look like it's going away in 2026. In April 2025, on Liberation Day, President Trump announced tariffs on pretty much every country that the United States does business with. The initial response to these tariffs were a global stock market crash because there was so much uncertainty until President Trump put a pause on those tariffs to allow for more time for negotiation. Well, here we are towards the end of 2025, and we have some more clarity with tariffs, but still a lot of uncertainty because some tariffs are still being renegotiated. Now, here's how this matters in our chart. Let's call this the economic system chart. On this chart, tariffs are another form of tax for the United States government, because we all know that in earlier part of 2025, President Trump passed the One Big Beautiful Bill Act. And that bill is working to cut taxes for many Americans across the board. Well, the lower tax revenue is hoping to be subsidized through those higher tariffs. So we'll ultimately see in 12 to 18 months how our tax revenue change when you factor in the One Big Beautiful Bill Act and the tariffs, but it's expected that the rise in tariffs are not going to fully offset the tax revenue loss from the One Big Beautiful Bill Act. But this is where you also have to pay attention to spending, because remember, our economic system runs on spending, and some people are concerned that the tariffs could reduce spending. Why? Because if businesses have to pay more money to produce their products, that could lead to higher prices for things in the United States, which would cause a reduction in spending. And that could also impact the changes with how foreign countries look at the United States and want to deal with the United States. That's why these tariffs create a lot of uncertainty. It's not just, oh, it's an additional 25% fee. It's what is that going to do in terms of tax revenue? How is that going to impact spending? And how is that going to impact the United States dollar and foreign countries' relations with the United States government? But then we also have to couple that with taxes. Like I said just a minute ago, the One Big Beautiful Bill Act is one of the largest tax cuts in American history, which is going to impact many people, whether you're a W-2 earner, a business owner, or an investor. It is going to change how much money you pay in taxes, which is going to reduce how much revenue the United States government gets, while spending isn't really changing too much. Now, I've already done a full deep dive on the new tax bill and different ways that you can capitalize on the changes in the tax bill. So I'm not going to go over all that in this video, but if you want to watch that, I will link it for you down in the description. But the reason why tariffs and taxes tie in with inflation has to do with this. So inflation comes from the word inflate. What do you inflate when you have inflation? You are inflating the monetary supply. Most people assume that inflation means the prices of things are going up. That's the byproduct of inflation. Because when you create more dollars, the value of each dollar goes down, causing the prices of things to go up. So now let's take a look at the scenario. If tax revenue falls, because yes, we're going to get some more tariffs, but we're most likely going to see an overall lower tax revenue because, well, tax cuts from the bill and tax raises from the tariffs overall is expected to reduce the total number of taxes. If that's the case, we'll have less taxes while spending is not slowing down. To make up for that difference, that means more debt. Plus, if we have lower interest rates, that debt becomes a little bit cheaper. So that could also mean that the United States government has the ability to borrow more dollars. Those borrowing of more dollars from the Federal Reserve Bank or anywhere else could lead to a boost in spending. It could lead to a boost in the economy for the right people, but at the consequence and cost of more debt, which could lead to now more inflation. More inflation could then lead to higher prices of things. That's what you want to pay attention to. And when that inflation happens, that benefits certain people, like investors, because we know that investors generally benefit from inflation. Stocks generally benefit from inflation. Real estate investors generally benefit from inflation, while the average person who is just a consumer, well, you're paying all the higher prices because we know the salaries generally don't keep up with inflation. We know that the average person now, if you're just a consumer, you have to pay more money to buy your stuff, while incomes don't keep up, while asset prices continue to rise. So it's important for you to pay attention to this, because if we continue to see more government spending and that's subsidized through more debt, that could boost the economy, that can benefit investors, but it comes at a price, and the price is going to be paid by the average person. And this brings us to the last but not least shift you want to pay attention to, which is, of course, debt stress. And there are many levels of this debt stress. I've already talked about this national debt stress, because the fastest growing expense for the United States government is, of course, our national debt, which means the fastest place where your tax dollars are going is not welfare, it's not infrastructure, it's not healthcare, it's not social security, it's right back here to paying back that debt plus interest. So we know that this national debt has a big burden for the United States government, which is one of the reasons why the government wants to see lower interest rates as a way to lower the burden and boost the economy by having the ability to borrow more money. But that's not the only place where we're seeing that sort of debt stress. We're also seeing delinquencies on auto loans and credit cards rise, because more and more Americans are starting to feel the pinch of the economy, because wages are not growing while the prices of things have gone up a lot over the last 5 years. And so we're seeing a growing number of Americans underwater on their debt. And at the same time, we've been seeing consumer confidence fall in the United States, because Americans are also concerned about the job market. They don't feel like it's easy to get a good job. They don't feel like there's a lot of good jobs out there that are growing with incomes and wages, especially with the growing cost of living. And with all these things come together, that's where some people are concerned about the economy. Now, of course, nobody knows what's going to happen tomorrow. Nobody can predict that. But this is why it is so important for you to become an investor and to be financially educated, because the reality is it costs money to eat. It costs money to feed other people. It is important for you to understand money. That way you can take better care of yourself, your family, and your community. And, well, there's a lot of changes happening in our economy. Now, it's not new to see changes in the economy. That's been happening forever. But the shifts that we're seeing today are unique to today. And you want to understand this, because all of these shifts make it more and more critical for you to become financially educated and to become an investor. That way you can capitalize on all the shifts that are happening. And again, if you want to understand different ways for you to invest your money and find better investments, I've put together a free investing masterclass, and I have that link for you down in the description. According to Forbes, banks are quietly tightening up their lending standards, meaning it's getting harder for people and businesses to get a loan. We've seen this happen before. In the past, when banks would get stricter about their lending practices, it has been an indicator for an economic slowdown. And now with banks tightening the lending standards again in 2025, the question is what's coming next?